So we've been talking tax, and this is the last lecture then that we're going to talk tax. If you remember my very first lecture that we did, I said to you that the rule for tax, or accounting for tax, was that we account for tax in the same period, at the same time, as for the transaction. And so therefore, if we do that, we land up with deferred tax, isn't it? Because deferred tax says I've either paid tax in advance, so I have an asset, or I have to accrue tax. I have a liability because I will pay tax later, not now, for a transaction that I've recorded now, isn't it? And so therefore, the fact that we account for deferred tax should then give us a situation where if I take profit before tax, whatever that is, let's say it's 1,000 Rand, my tax expense should be 28% of that, should be 280. And this tax expense is made up of current tax and deferred tax. Yeah, so what deferred tax does is it makes your tax expense in your P&L a straight 28% of the profit before tax number. And I'll show it to you with an example, but that's what deferred tax is. Deferred tax is this rule that I have where I account for tax at the same time as I account for the transaction. This rule that I have is what leads to the deferred tax. And then, because of that rule, if I apply the rule correctly, whatever I've shown as profit, 28% of that will always be tax. Yeah. So let me show it to you with a quick example. Let's assume I have it's the first year that a company is trading, and I have a very simple example where the only adjustment to my tax calc, and let's assume my profit before tax was 1,000, and my only adjustment or my only difference is depreciation and wear and tear. Yeah. So let's assume my depreciation number is 200, and let's assume that my wear and tear is 250. So it would look like that. Do you agree with me? I add back depreciation, take off wear and tear, and I'll end up with that as being my current tax, or what I have to pay current tax on. When I multiply that by 28%, I get tax of 266. Okay. Then I have deferred tax. So that was current. And then I have deferred tax. In my deferred tax calc, I have carrying amount, tax base, temporary difference, deferred tax. And let's assume that my asset was 1,000 Rand asset. I would land up with an asset which, if I take 200 of depreciation off, had a carrying amount of 800. And an asset that has a tax base of 750, if I take 250 off, do you agree? I'll end up with a temporary difference of 50, and on 50 deferred tax is 14, and it's a liability, which is therefore a debit in my P&L. Do you agree? A credit to my financial position, a debit in my P&L. Debit P&L, credit financial position. So therefore, if I do a P&L, and here's my P&L, let's do the P&L in blue. My P&L would look like this: profit before tax, 1,000. Tax expense, which is made up of current tax plus deferred tax, of 280. And do you see that it is a straight 28%, isn't it? So what deferred tax does is it forces your tax expense to be 28% of whatever you've accounted for, because of that rule that says I'm going to account for tax when I account for profit, okay? So this discussion is leading somewhere because there would only be one reason why this 28% would not be true, or there wouldn't only be one reason. There are a couple of reasons why this 28% wouldn't be true. And those reasons is what we will then put into a tax recon. So accounting, or the accounting principle for tax says account for tax when you account for the transaction. We therefore expect the tax expense to be a straight 28%, isn't it? There will be a number of reasons why it's not, and we have to disclose that in a tax reconciliation to show our users why not, isn't it? So a tax reconciliation appears in the tax note, and a tax reconciliation starts with profit before tax at 28%, whatever it is, 280. Yeah? And then it will reconcile to the actual amount of tax expense in my P&L. And in the scenario I just gave you, the tax expense in the P&L was 280, and so therefore there's nothing to reconcile. Do you agree? However, there are reasons why it wouldn't be 280. And the most common of those, which is ones that we've been seeing as we've been working on tax calculations, are our exempt items. Our exempt items. Do you agree that exempt items are either not taxable or not deductible, isn't it? So they will cause the 28% to not be valid. Do you agree? So whatever exempt items you've got in your tax calc, you bring them into here at 28%. So if I have fines, donations, if I have capital gains, which are exempt, but that's exempt, the 33.4, all of those items I will bring into here at 28%, and this would come from my tax calc. There's one more item which comes on here, or there's a couple more, but there's one more that we've also talked about, and that's when we have a rate change. Do you agree a rate change is something that relates to prior years? Because when I do the rate change, what am I changing? Deferred tax, beginning of year, isn't it? So rate change belongs in prior years. It relates to prior years. It's never going to make this year's tax expense balanced, isn't it? So rate changes, which is from my deferred tax calc. It's not really the deferred tax calc, it's the deferred tax movement calc, isn't it? Movement calc. Any rate change would come in here as a plus or minus depending how it's affected the tax expense. I look at how the numbers have affected the tax expense. Okay. There's another item that comes on here that I think we have seen. Foreign tax. Foreign tax. Do you agree that foreign tax is not at 28%, isn't it? Because every country's tax rates are different, isn't it? The amount of foreign tax that comes into a recon is the difference between the actual percentage and the 28%. That's the amount that comes into my recon. Let me show you an example of that foreign tax, because students often get confused with that foreign tax and how it works. Let's assume that I have foreign income of 50,000, 50 million, whatever it is, yeah? And let's assume that I paid tax of 10. So in other words, I've paid tax at 20%. Do you agree with that? Okay, so now, when I look at my numbers, this foreign income is sitting in profit before tax. Do you agree? So included in here is an amount of 50 times 28%, which means I have an amount of 14 included in there. Do you agree? Because the foreign income is sitting in profit. All I've done is I've taken profit before tax at 28, so in there is an amount of 14. Yeah? But when I look at tax expense, what's sitting in tax expense? This number, isn't it? That's the foreign tax that I paid. So foreign tax expense is only 10. It's not 14, isn't it? So, of course, I'm never going to balance to 28, isn't it? And I'm never going to balance because of the 4, isn't it? So, if I take the actual percentage, which in this case was 20%, and I subtract the 8%, I get a minus 8. Do you agree? Minus 8 times 50 is 4. And I land up with a minus 4. And minus 4 is what I need to balance from a 14 to a 10. Do you agree? So when I look at foreign tax, what I'm looking at is the difference between 28, which is what I expect to see when I look at my tax expense in my P&L, which is what my shareholders expect to see, any users expect to see, and what I actually paid. So foreign tax is the difference between the actual percentage and the percentage paid. All right, so then there's only one more item that comes in here, and that is any under or over provision of tax, for tax. And this is from prior years, This here comes about when, for prior year, what I had accrued for tax, prior year what I had accrued for tax, in other words, when I did my tax calc, and I put the numbers into my P&L, and I said, my tax calc says I'm going to have to pay SARS, 20,000 Rand, and that's what I put into my P&L, and that's what I leave on my financial position, isn't it? I owe SARS. When the prior year accrued does not equal what was assessed. When the prior year accrued does not equal what was assessed. When that happens, I have an under or over provision for tax, isn't it? So let's assume I had accrued 20, but SARS comes back and says, you owe me 23. I have to pay him 23, but I only have an accrual of 20, so the other 3 I'll end up having to expense, isn't it? And I expense it as an adjustment, an under provision of prior year. That's how I expense it. So it lands up in the expense over here, isn't it? Together with the foreign tax, so this expense is made up of a whole lot of things. It's made up of current tax, deferred tax, and it's made up of all these other things that I have up here. It's made up of a rate change, it's made up of foreign tax, it's made up of under or over provisions for prior year. All of those items land up in my tax expense, isn't it? And so therefore, when I'm reconciling, I have to put all of those items in here. Okay, let's look at an example. And the example is, in your study guides, it's example 14. It's on page 51. All right, so if we look at this, they've given us T accounts, and I know that some of you probably are not familiar with, or that familiar with T accounts, or not that used to working with T accounts, but you need to be able to interpret them. It is something that you learned going back to school days, isn't it, T accounts? So if we look at this T account, the first T account we get given is the SARS T account. It's the amount owing to or by SARS in my financial position. And it starts with an opening balance, which is a credit, and it says, we owe SARS 7,600 Rand. This was at the beginning of this year. Okay. And then what you'll see coming through on this account is that, and that related to 2011. Do you agree that that would have related to 2011? Okay, because this is February 2012. So if I have an opening balance, it's the balance of tax that I owed for 2011. Do you agree? Okay. So then if I carry on looking at it, what you'll see is that there's an entry here which says current tax expense 2011 adjustment. So here's a 2011 adjustment of 8120. So what that's telling me is that I thought I would have to pay SARS 76, but it looks like I've had to pay him an extra 8120. 8120, do you see? And on that side over there, I see I have a bank entry. Bank for the 2011 tax year, 16,000. Well, that doesn't quite balance, isn't it? 16 doesn't quite balance to that side. So I don't know quite exactly how that's worked. Okay. The rest of the entries relate to 2012. So if I look at the rest of the entries for 2012, I have a tax expense for 2012, current tax expense for 2012 of 39. I've paid provisional tax for 2012, bank for 2012, bank for 2012, 18 and 18. I've paid 36, and I therefore still owe the difference. So this closing balance over here, some of it is 2012, a bit of it is 2012, and then there's a bit there that's 2011 still, isn't it? That needs to be sorted out. Usually what happens is that, and I'm sure there'll be something in the story, when I've underpaid tax, there's usually interest and penalty implications, isn't it? So chances are that the extra amount that I paid, because can you see I paid more than what I owed, isn't it? Because when I look at this, it's only 15,720. So I paid an extra 280,000 Rand or 80 Rand. That extra bit that I owed there probably was interest, and it hasn't been accounted for correctly. Then the next tier account they've given us is a UK Inland Revenue account. UK Inland Revenue. And UK Inland Revenue, there's an amount here for tax of 21,000 Rand, which I still owe. Yeah, can you see it's a liability still? Brought forward as a liability. So there's some foreign tax there that's owed of 21,000. I don't know what the income was. I would have to check. Then they give us a deferred tax account. And if I look at the deferred tax account, there's a couple of things there. I see a tax expense for the year of 84, and I also see a rate change going the other way of 1,500. Yeah. Additional information: the tax rate changed from 29 to 28. The deferred tax comprised taxable temporary differences on plant and machinery. The adjustment in respect of 2011 relates to the 2011 assessment. We claimed expenditures which were not allowed as a deduction. The profit before tax for the year is this much. Okay, so my recon is going to start with that. Do you agree? 325 times 28%. All right, so let's have a look. I have donations paid, dividends received, fines, and income from the UK. Here's my income from the UK. 140. I paid tax of 21, wasn't it, that I saw? Okay. The income received from the UK is not taxable in South Africa as a result of a double tax agreement. And then there's amounts at the top here. Those amounts at the top there are permanent. Do you agree? Permanent differences. So this one, and this one is exempt items. It's donations, it's dividends, it's fines. Yeah, exempt items. It says disclose tax in the notes. So if I look at they're down here. It starts at the bottom here. So if I look at the tax in the notes, there's obviously a tax calc that's been done. Here's the current year, current tax expense, current year, 39,900. Comes from that T account actually, isn't it? So if you look at that T account, the expense for the current year, 39,900. And then there's an under provision from the prior year of 8,120, also from that current account, giving me a total current tax of 48. Then there's deferred tax expense, also from that T account, current tax, temporary differences, and then a minus for the rate change because the rate dropped. Yeah, giving you deferred tax. And then here's my recon. So my recon starts at 325. 28%. That's what I expect to see as my tax expense, 91. Yeah, because if I follow the rules in IAS 12, which says account for tax when you account for the transaction. If that's what I've got as profit, that should be what I would have as tax. However, when I look back at my tax note, this is what I have as tax. Here's my foreign, 75, isn't it? So you'll see that my recon reconciles between the 91 and the 75. I have to explain to shareholders why, if I'm accounting for tax in accordance with accounting rules, my tax isn't 91, it's only 75, isn't it? So that's the recon. So the first piece of the recon, as I said to you earlier, are these exempt differences. I must calibrate. The first thing are these exempt differences. And the exempt differences come in at 28. So you'll see they're all coming in at 28. Fines at 28. Donations at 28, dividends at 28, yeah, those exempt differences. And you'll see that they're coming in the same direction that they would normally go into your comp at. So fines and donations, we add back in the current tax calc, so here we add back. Donations, dividends received, we subtract, they're not taxable, do you agree? So here we subtract. So the approach actually to do it is when you're doing your tax calc and you're picking up these items, immediately come and stick them in here, because then you've dealt with them as much as they need to be dealt with. Do you agree? Then we have the easy ones. Let's do the easy ones first. We have the rate change and we have the under provision. The rate change and under provision come onto this calc. Help if I... Okay, there. The rate change and the under provision come into this calc exactly as they are here. Right? So whatever numbers you've put in here, you put the exact same numbers in the exact same direction into your calc, into your recon, right? So however they are here we've got an under provision which is a plus, and we've got a rate change which is a minus. Those things relate to prior years. Do you agree? They don't relate to the current year. They would never make the current year balance to 28. And so therefore, when I bring them into my tax recon, I bring them in exactly as they are at the top to force it to balance. Do you agree? Because both of these relate to prior years. So they will never make this year's profit balance to 28 because they relate to prior years. They don't relate to this year, isn't it? So our exempt items are there. Our tax rate change and under or over provision is there, which is our prior year stuff. And then we're left with our foreign tax. And if you looked at our foreign tax, I'm going to do a little calc here just to show you once again what happens with foreign tax. Included in this 325 is foreign tax of 140, foreign income of 140. Agreed? I paid tax at 28%. No, I've put it in there at 28%. So at 28%, the amount that's sitting in here is 39,200. Agreed? However, the amount that's sitting in here is the amount paid, which was only 21,000. Agreed? So I have to balance from 39,200 to 21. So I have to take off 18,200 to get me from 39 to 21. Yeah? And when you look at the calculation is exactly what I said to you, which is the actual, so I wouldn't do it like this because then it doesn't get your direction perfect. But if you said actual percentage times minus 28, you would get a minus 8 because the actual percentage was, no, I don't know what the actual percentage was. What was the actual percentage? 24, it was 21 out of 140. 15%. Do you agree? 21 out of 140. 15% was the actual percentage, minus 28. So it's a minus 13. So if I take 140 and I times by minus 13, I get minus 18,200. Yeah? Okay, so a quick way to make sure your calc is correct, actual percentage minus 28%, or the actual rate. And then whatever you get, you put in as a plus or a minus. If you get a plus, it's a plus. If you get a minus, it's a minus. In some countries, there's more. The tax rate might be higher than in South Africa. In some countries, smaller. Okay? So there's your tax recon. This tax note with the recon is worth, or can be worth, a lot of marks, isn't it? Because look at how much work it took just to do, we've spent 3 lectures on it, isn't it? How much work is it just to do this tax note? Because this is what the tax note looks like. It looks like this. Income tax expense, major components of tax expense, current tax, current year, prior year, over or under provision, deferred tax, current, which is your temporary differences, and rate change, foreign tax, and that's your total number. And then the recon, which looks like that. So that can be worth 20 marks in an exam. Why? I have to go do a current tax calc, I have to do a deferred tax calc, I have to do a deferred tax movement, I have to calculate a rate change, I have to go and see if there's under or over provisions from prior year, I have to work with the foreign tax, isn't it? And then I have to plug it all in to get the final numbers. Do you agree? So if we look at the assignment question, for example, that's the assignment question, isn't it? Step by step by step, what we've been doing. And so today we're going to do in the assignment question this piece, which is the last piece, which is then to say, okay, what does my tax note look like, including the tax recon? But before we get there, I just want to talk about or touch on dividends tax, because it's the last bit then that we need to cover, and there is a dividends tax journal entry sitting in that assignment so that we can then finish that assignment. Dividends tax. Okay, so I don't know how many of you have heard of STC, secondary tax on companies. Nobody? It's one. So it used to be that was the dividends tax. It was STC, but it's now been replaced with, and so it used to be that the company paid the dividend tax, not the shareholder. And so in the shareholder's hands, it was always exempt. That's why in our tax comps, we always see it as exempt, okay? But they changed that. They've now made dividends taxable in the hands of the shareholder. So what is dividends tax? The shareholder pays tax of 15% on dividends received. It's actually discouraging, isn't it? Because that money's already been taxed in the company, and then they pay a dividend, and then the shareholder pays again tax on that same money. So this is the dividends tax. The shareholder pays tax of 15% on dividends received. However, SARS has put in a rule which says that this tax of 15% must be withheld. It's a withholding tax. It must be withheld by the company before the company pays the shareholder. So if we have a scenario where here's a company, and here's a shareholder, and the company pays a dividend to the shareholder of 100 Rand, what actually the company must do is it must take the 15 off, only pay the shareholder the 85, and pay the other 15 to SARS. So the journal entry is debit, bank, SARS, pay SARS, 15. Debit, bank, no, I've got it the wrong way. It's not debit bank, it's credit bank. Debit, let's leave it in blue. Debit, dividend paid, or retained earnings, because dividends come out of retained earnings, 100. Credit, bank, SARS, 15. Credit, bank, shareholder, 85. You might find that they'll say to you, we declared a dividend, we haven't paid anybody yet. Yeah? If they haven't paid anybody yet, then this is not bank. This would just be SARS. And this would not be bank. This would be shareholders for dividend, an accrual. Yeah? So if they declared the dividend but they haven't paid it yet, we accrue what we owe SARS, we accrue what we owe the shareholder. And that's the way that the dividends tax works. So dividends tax is not an expense in the company. Do you agree? We will not ever see dividends tax in a tax note, in a tax expense, in a P&L, because dividends tax has got nothing to do with the company. Nothing in company AFS, annual financial statements. Nothing in the company's annual financial statements for this dividends tax. Because it is just a withholding tax. When the company, it's almost like PAYE. When the company pays you a salary, they keep some of it back and pay it to SARS, isn't it? When the company pays you a dividend, they keep some of it back and pay it to SARS on your behalf. When you then declare dividend on your return, you will declare that you received a dividend, but that but it doesn't matter because SARS already has the tax on that dividend, isn't it? Okay, so now what I've explained to you now is what applies to natural persons. So that's another thing. It applies to individuals. When we have dividends flowing through groups of companies, you know, you have groups of companies and the one pays the one a dividend and the other one, the dividends flow up usually. I'm going down like this, but they flow up, isn't it? The bottom subsidiary pays up and then that subsidiary pays up and eventually it pays to the parent and then eventually the parent takes everybody's money and pays it to their shareholders, isn't it? When you have that, there's usually an exemption, isn't it? Because if you receive a dividend and you've paid a dividend, it should be a null effect for you, isn't it? So usually there's that exemption, there's that null effect that flows through. But you won't see that because you're going to only see a company paying a shareholder dividend and you're going to see that happening. And in our tax calc, we saw already when we have dividends received, we remove it as exempt, isn't it? And so that will continue. Let's have a look. There is an example. It's example 16, so it's just a bit further on. 57. On the 31st of January 2013, Money declared a dividend of 1,000 Rand to Mr. O and its only shareholder. The dividend was paid on the 10th of March. So the dividend that needs to be paid is 1,000. The amount paid to shareholders will be 850. The dividends tax that will be paid will be 150, the 15%. So when we look at what happened, if you look at the journal, we paid the dividend to the shareholder, but the dividends tax was only paid to SARS in March, a month later. So as at the 31st of January, we have dividends paid coming out of retained earnings, 1,000. We have a bank entry of 850 when we paid the shareholder, and we have a SARS, a payable, for the dividends tax of 150. Then in March, when we pay SARS, we debit that payable and credit bank. Okay, so you'll see here what they talk about the exemptions. Yeah, South African companies are exempt, governments are exempt, public benefit organizations, mining, rehab trusts, and persons referred to in section. So those things are not things that you need to be aware of. Maybe in tax you deal with it. But we're talking about individuals here, when you pay to your shareholders, individual shareholders. All right, so that's dividends tax. So let's have a look at where we are with this assignment. We've looked and looked. Okay, so we started lecture 1 by doing this current tax calc, and the current tax calc was for 17.5 marks. Yeah, it was quite a long calc. Current tax calcs usually about a page long. Do you agree? I would always leave a whole page for current tax calcs. Then part B asked you to do the deferred tax movement, including a rate change in the statements of P&L, using the statements of financial position approach, using the balance sheet approach. Yeah. And so there we had to do a deferred tax calc for end of year. We had been given a beginning of year balance, do you agree? And so we then did a T account and worked out a movement. And we also had a rate change. So that was for 7.5 marks. We now have C and D left to complete. C, No, see we did, right? He asked you to prepare the journals for the current tax expense calculated in A and the deferred tax expense calculated in B. It's just simple journals, isn't it? Debit tax expense, credit SARS, and the other one was debit tax expense, credit deferred tax. Yeah. Journal narrations are not required, so that was 3 marks. D is the one which is for the dividend. D says prepare the necessary journal, and it's also small, 3.5 marks. Prepare the necessary journal for number 7 in the accounting records for the year ended 31 December 15. So if we look at number 7, you'll see that number 7, we've been ignoring 7 now. 7, Classic declared a cash dividend of 220,000 Rand on 31 December 14. All the shareholders are natural persons. The dividend, as well as the dividend tax, was paid in cash 31 December 15. So we didn't pay it. We declared it, but we didn't pay it. The payment of dividends and dividend tax have not yet been recorded in the accounting records of Classic. The dividend tax rate is 15%. So you need to do that journal. Yeah? And it's for 3.5 marks. They don't want the journal, they only want the journal as at year end. So you don't have to do the payment journal in January. You must just do the journal as at December 15, right? So it's just going to be dividends paid, equity, credit SARS for dividends tax, credit shareholders for dividend is what it's called. It's in the statement of financial position, it's a credit, a payable. Yeah, payable. So that's that one. And then E for 18.5 marks, right? So you can see, remember when I said to you it can be 20 marks. It could actually be more, isn't it? If you think about, if they didn't ask you to do A and B, you still would need to do A and B to be able to do E, right? Because you need to do the current tax calc, you need to do the deferred tax movement so that you can put it in the note. So E, which is the note, including the tax rate recon, says disclose the income tax expense note, including the tax rate recon, and the deferred tax note. The deferred tax note we already did last week. Yes? No? Okay, well, we need to finish that today. For the year ended 31 December 15 in accordance with the requirements of IAS 12. I want to just point out this bold bit. This bold bit over here says, including the tax rate recon using Rand values. There are 2 ways to do a tax rate recon. You can either use Rands or use percentages. If you use percentages, you're going to be reconciling between 28 and the effective tax rate in the P&L, yeah, which is tax divided by profit before tax. It is much, much harder to do a tax rate recon with percentages, right? So we never see it with percentages. We always just see it in Rands. But sometimes, and this is when you start working, some clients want their tax rate recon to show percentages because they feel it's better information to shareholders, because it shows shareholders that although the tax rate is 28, management have structured their tax affairs in such a way that they've managed to reduce the effective tax paid to maybe 25 or to 24, isn't it? And they want that to be very obvious when somebody's looking at their financials and says, sure, look at this company, they've managed to reduce their tax bill down to 20 or whatever, because they've structured their tax affairs. Because that's what tax consultants do. They help companies to structure their tax, to structure their transactions, their contracts, etc., so that they get the most tax benefits they can. So you'll see that your things will always say using Rand values only, and in case you're wondering, what the heck, why do they say that? That's why. Tax recons you can show in Rands or percentages. We will always work in Rands. And I can tell you, because I've done it in percentages before, to get to percentages, we first do it in Rands. Then we take all the Rands and we divide by profit before tax to get to percentages, to get it to work. Because otherwise it's really hard to get it to work. Okay. All right, so we're going to do D first and get that dividends tax journal out the way. And then once we've done D, you're going to go back to everything that we've done so far. And you're going to start to pull through that information into that tax note and into that tax recon. And let's see if we can get that to work. If your recon balances, then that's a really good warm fuzzy that everything has gone right, isn't it? If your recon doesn't, then yeah, you must be missing stuff somewhere.